Hey everybody, good to be here. It is Wednesday, time for managing an options portfolio, and as usual, we'll go through some looking at some existing trades in our paper money account, talk about managing them. But before we get there, I do want to talk about a few approaches to kind of a framework, I guess, in terms of trying to decide what kinds of trades you're going to do. I want to talk about a 3-step framework. We're going to talk about that coming up in just a little bit. But before I get there, let me just mention a couple things. I'm joined by Mr. Ben Watson helping me out in the chat. Always appreciate Ben. And if you're at a workshop, check out our live event schedule. Ben does workshops around the country, larger cities typically. But if you're willing to travel just a little bit to those larger cities, they're great setups. Check out Ben. He also teaches a wonderful market movers class on Fridays, 4 o'clock Eastern time. You can follow him on Twitter at Ben Watson CS. At Brent Moore CS is my Twitter X handle. And Ben and I both post additional content throughout the week on X. And before we get too far into this, let me just mention that options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only and should not be considered an individual recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Paper money application is for educational purposes only. All investing involves risk, including the potential loss of principal. And for the sake of simplicity, my examples may not factor in commissions and fees. Just make sure you're aware of those. Paper money application does not assign short option positions early, which is different than a real account. Past performance of any security or strategy does not guarantee future results or success. Thank you so much for joining me, everybody. See some familiar names in the chat. And, between Ben and myself, we'll try and get your questions answered in that chat here. So I do want to get to management of trades, but I want to talk about kinds of like a 3-step process, if you will, in terms of deciding what trades that you're going to do. And so let me do this. I'm going to go up here. I'm going to bring up a scratch pad. And I'm just going to kind of maybe list them out right there. Let me get rid of that. I don't need it. That's old. I don't even know what that is. And number one, the first kind of thing I want you to do is do a kind of a market posture as a way of deciding what trade to go through. In other words, if we're looking at the market, the question is, are we bullish, bearish, or you could even say neutral, okay? And for that, typically what you may do is you may look at an index. I have the S&P 500 right here. You can see where we've gone. This is a year chart. Well, let me go to a 6-month chart with a 20 and 50-day moving average. We had the big pullback. Seems like this is a significant support level to me. It was a resistance here. It kind of bounced off it there. We broke down, we gapped to it, and then it held. It held. We broke through it, and we've held it intraday since then. Now, we've kind of come up, maybe flagged a little bit, but that does seem like a significant support level for me. We've had a low, a higher low, and we had a high, higher high. In other words, it does appear that the trend is changing. Okay. Now, by no means am I suggesting that we're going to have smooth sailing. I don't know what the future holds. There's still a lot of uncertainty. If you ask almost anybody, they're going to say there's a lot of uncertainty in the market right now. So you got to come up with your forecast. Bullish, bearish, neutral. I can make a case for all three, to be honest. But in terms of what we've been doing lately, it's been a little bit more on the bullish side of things. Potential resistance there, potential support there. Does it slip into a channel? So for our purposes initially on this trade, on our trade, I'm going to say the market posture here is more bullish. There's a lot to come. We have a Fed meeting today, everybody. Not many people are expecting a change in interest rates today. But what is going to happen is Jerome Powell's going to hold a press conference. So they're going to release a statement, probably around 2:30 Eastern time. And that can certainly move the market, and that can change the posture of the market. Other things can change the posture of the market as well. A trade deal gets announced. That would certainly affect market posture, probably. Economic data, inflation data can affect your market posture. Or lack of trade deals could eventually wear on the market and affect your market posture. So a lot of different variables in there that affect your market posture. But my point is, your initial thing when we're looking at an individual stock is to look at the overall market, such as the SPX, S&P 500. You can look at other indexes as well if you like, and come up with a market posture on that. Okay, so that's number one. Number two, when you're deciding what kind of option trade you're going to do, okay, this is an options trading class, so we're talking about options trading here, is to think, are you going to be a buyer or a seller? Okay. And when I mention that, what I'm referring to is what's implied volatility. I'm just going to write IV. And where is implied volatility going? Okay. By the way, there's a survey link in the chat. We do appreciate your feedback on that. So you can be bullish in the market and you can be an IV buyer of implied volatility. You can be bearish in the market and be an IV buyer. You can be bullish and a seller or bearish and a seller and so forth, okay? You can be neutral as well. Kind of focus on bullish, bearish, but you can be neutral. And so really what we're going to come down to on that is we're going to look at like probably implied volatilities. We can look at them for the whole overall market. We can look at the VIX and we can see where the VIX is. Let me zoom out just a little bit on this. I'm going to go to a 3-year chart and see where we are. Where are we going? Well, look, as the market goes up, there's going to be a tendency, if the market goes up, for implied volatilities to drop. If the market goes down, there's going to be a tendency for implied volatilities to go up. You can see where we are right now. This is where we are right now, around 24.5. You can see that I'm going to try and draw my line kind of straight here. It's going to be a little bit crooked, but we'll do our best there. And you can see most of the time, we'd consider this to be a fairly high level. Obviously, we spiked up. Where is this going to go? I don't know, but if your forecast is for it to go down from here, you may favor more selling strategies. Okay? If you think it's likely to go up from here, you may favor more buying strategies. Selling strategies benefit if you have higher implied volatilities that go down. Buying strategies benefit if you have lower implied volatilities that are going to go up. One way to think of it is this. Oh boy, hold on. Let me see if I can make this a little bit neater than that. That was not a good start. I was going to try and do kind of this matrix here, this 2 by 2, I guess, grid. You could buy in the market. You can sell you can do selling strategies in the market. You can be bullish. You can be bearish. And this is just a real simple chart, okay? If you're bullish and you're buying in the market, you're probably going to have strategies that are more based on things like long calls, okay? If you're bearish in the market and you're buying volatility, I'll put a V under here for buy and sell, and I'm buying volatility, I'm more likely to do things like a long put. Okay? Now, just because a strategy has a long call in it or a long put in it, such as a vertical spread, doesn't mean it's bullish, because then you may also have a short call and a short put. So we're looking at the net of it. But for our purposes, for example, I teach a class on long options on Tuesdays. And in that, we buy long calls, we buy long puts, and they benefit if the implied volatility goes up. Well, that can be a little bit of challenging. Lately, implied volatilities for the most part have gone down. And so it has worked against our strategies there. Similarly, if we're selling volatility, I could do a short put if I'm bullish or a short call if I'm bearish. Now, there may be other factors in there. We may not just we may elect to not do just a plain short call without any stock or anything, and may not just do a naked call, because there's a theoretically unlimited risk on that. But those are the basic strategies there. Now, we may branch out a little bit, and let's say we're bullish and we're selling volatility, we may do something like a short put vertical. Okay? The volatility effects aren't going to be quite as great because it is a vertical spread, but that may factor in there, or a short call vertical if we're bearish. But that's the basic framework we're talking about there. Okay? Now, in the chat, George said, I use implied volatility percentile on the underlying to say, so let me follow up on what George said, because George brought up a very good point. Let's say we have a stock. Let me pull up a stock, not the VIX. The VIX is not a tradable security. Let's do Microsoft, MSFT, just as an example. One thing you can do is you can look under the option chain and you can go to today's option statistics, and you can see things like the current IV percentile right there, 25%. So what that is saying is, over the last this looks back at the last 52 weeks, about 25% of the time, implied volatilities have been lower than where it is now. About 75% of the time, implied volatilities have been higher than where it is now. So that's one approach to the market on this. And so that is a little trick of the trade. You can use that. Another thing you can do is you can just pull up a chart. You can pull up your implied volatility on that. It's a study. Go to the little flask up there and click on IV. I actually have it quick linked here. But go to the flask, pull up implied volatility, and you can see where that implied volatility is now compared to where it's been. And that's a 3-year. Sorry, let me go to a different time frame here. Let me just go to, let me just do this. And let me pull up implied volatility again. There's a 1 year. You can see where our implied volatility is now compared to where it's been, okay, on that. So that's the basic framework. That's number 2. Are you going to be a buyer or seller after you come up with your market posture? And you can do the same things both for the market. In this case, we looked at the SPX and the individual stock. You can do the same thing for implied volatility, both for the market, the VIX would be the market, or the individual stock by pulling up your study right down there is the other way to do it. And there's another factor, another thing I would encourage you to maybe think about when you're doing your trades, and that is, number 3, are you going to look for higher probability or higher returns? They usually don't go hand in hand, folks. If you seek a higher return trade, higher potential return trade, is probably not a higher probability trade. For example, let's say we just did a long call. Okay, we're buying a call option. Well, where would that be? That would be bullish. Hopefully, that's a buying IV implied volatility trade. And is that going to be a higher probability or a higher return trade? Well, potentially higher return, because there's a theoretically unlimited return on a long call. But time decay works against us on those, and therefore we would not call it a higher probability trade. Let's say we sell a put. What would it be if we sold a put? Well, it's bullish. Okay, short put is bullish. Are we a buyer or seller? We're a seller of implied volatility. Higher probability or higher return? Well, number 1, the time decay is helping us out. So if it goes sideways, we're probably in pretty good shape there. But what's the most we can make on a short put? The most you can make on a short put is the premium we bring in. So it's not going to be a higher return trade. It's probably going to be a higher probability trade. So ask yourself those three questions when you're trading, and as we're going to start out. Okay? So let's do that, and let's look at a couple example trades. Then I want to get to money management of existing trades that we potentially have here. All right? So let's do this. Let's look at PayPal. Okay? I'm just going to pull up PayPal. I've got a 9-month chart here. PYPL. Here's PayPal. Bullish or bearish? Well, you know, things are changing a little bit. Let me zoom in just a little bit here. We certainly had a downward trend on this. This kind of was our trend right here. We broke out of that. Again, I'm going to zoom in just a little bit here just to focus on so you can maybe see a little bit better. We had a low. We had a higher low. We had a higher low. We had a high. We've had a higher high. Or another way of looking at it is to say, what if I throw on some moving averages? What are they telling me? Here's a 20 and a 50-day moving average. Our 20-day is solidly trending up. The stock is above that. That tells me my shorter term trend is bullish. My 50-day moving average, we've broken above that. That's still down, so it's a little bit mixed. It's still sloping down, but we're above it. But I'm going to call that more of a bullish posture on this. There's my first posture. We already talked about market posture, and I said, I'm going to go with more of the bullish stance on the market. Here's the stance on the individual stock, a little bit more bullish. Buyer or seller of implied volatility? Well, let's take a look at our implied volatility on this. So I'm going to pull up my implied volatility graph here. So here's my implied volatility. This is 6 months. We had earnings. We're below earning. We're past earnings. Actually, let me make this a year chart here. And what tends to happen with implied volatilities is before earnings, they tend to go up. They tend to go up before earnings. Here's earnings, okay? Here's earnings. Here's your implied volatility chart. Here's earnings. Implied volatility tends to go up. We've dropped after earnings, and then after earnings, of course, they drop. Here we dropped. Now, we had a bigger spike here just because of the whole market thing, but we did drop. So my assumption is this is going to tend to go up. Now, you may say, well, implied volatilities go up if the stock goes up. But look, even if implied volatilities go up if the stock goes down. But look, even if the stock is going up, you can still have implied volatilities go up as we get closer and closer to earnings. So in this case, what I'm going to say is we're bullish and we're going to be a buyer of implied volatility. Okay. Now, I can make it a higher probability trade or a higher return type trade. If I want to do a higher return trade, I may just do a long call there. That's certainly a possibility. If I want to do something that's a higher probability trade, I may switch at least to like a long call vertical, and then I can make it a higher probability trade. In that case, when you have a vertical spread, we're going to negate a lot of the implied volatility effects there on that, but we could still be bullish. All right. Now, so here's what we're going to do. When we manage trades, I'm going to get to some long vertical spreads here. Okay. I want to look at those when we manage trades. But for this purpose right now, I'm going to do just a plain old long call. It's bullish. We're buyers of IV. It's going to be a higher return trade. When we choose higher return, we know it's probably not going to be a higher probability trade, and it's not going to be that. But I'm going to assume we're going to do this a trend trade. So I'm going to go out and I'm going to go to trade. I'm going to go out about 50 days. I'm going to give it plenty of time here. Well, we don't have anything right at 50 days. I'll go 44 days out, okay? 44 days. And I'm just going to go maybe in the money just a little bit. Here's my calls over here. I'm going to go to the ask price. And we'll go, stock is at about 68 and a half. Maybe we'll go in the money. Look, the spread, 10 cents spread there. That's not That's not bad. I'm going to right click on this and I'm going to buy custom with a stop. Okay, I'll put a stop loss on this trade. I'm going to shrink down this left-hand column here. Now, we've got a long call. And I'm going to give you an example of a long call today, but just realize if you want to continue your long call education, there's a class or a webcast on Tuesdays devoted to long options. It's 50% long calls, 50% long puts. So I'm going to give you one example today, but if you want more details, check out that webcast. Okay, now let's go back here. Let me close this down. Now, can I add delta to columns? George says yes. Okay, and I'm also going to add theta to columns too. And let's add implied volatility to columns as well. You can do that right up here. Okay, and so I'm going to go to delta, gamma, theta, vega. Now, Chuck said, why bullish instead of bearish? Well, this is why. We kind of mentioned this before. Because we're now in an upward trend. We're above our moving averages. We have higher highs, higher lows. The assumption I'm going to take is this trend is going to continue. May not. And if you're bearish, then you wouldn't probably even consider a long call, right? You'd consider something else. Posture for this class is bullish. Okay, hopefully that answers that question. Let's look here. And there's a good question from Josh. And I'm going to address your question, Josh, in just a sec here. But let's look at this. Okay. We were looking at the 65 strike, right? 65 strike. Here's my delta. Delta's 71. Okay. Often with long calls, we'll go in the money a little bit. You can go out of the money, but it becomes a more aggressive type trade there. We necessitate a bigger move typically on those. Because in the case, if we're out of the money, and this is all extrinsic value if it's out of the money. That means if the stock stayed right where it's at, this ultimately is going to be worth zero at expiration. Now, if the stock stays right where it's at, it's probably not going to be, it's still not going to be a great trade. You know, we need this thing to go up. But there's my delta. That means, what does delta mean? Delta means if PayPal goes up a buck, 68.50 to 69.50, then the option is likely to go up about 70 cents. It's an estimate. So from 5.50 up to 6.20-ish, right? So that's what delta tells me. You can apply that same rule for delta for all these other options if you like there. Okay. Now, so that's delta. Well, let's get to theta and vega in a sec. Josh said that, what about the break even? Well, what is our break even here on this? If we chose the 65 strike, at expiration, what price does it need to be at for us to be break even? Well, I'm going to take that strike price. I'm going to add my premium. I'm going to say 550. 65 plus 550 is 70.50. Okay, 70.50. Very often when we're doing vertical spreads, we'll just absolutely look at that break-even point at expiration. I think it's a key thing. Long options, I often don't explicitly mention it, but you should have some idea in your head what it is. This is our break-even at expiration. Before expiration, that's not our break-even. In other words, if this stock went up to 70.50, say tomorrow, we wouldn't be break even. We'd very likely have a nice little profit on our hands at that point. But so break even at expiration is probably a good idea to have some idea of what that is. Whether you kind of work out the math exactly as I did or look at it. 70.50. I'm just going to draw a little line on my chart where 70.50 is. And George brought up a good point. I didn't mention commissions there. Technically, we'd have to add in commissions there on that. But here's about roughly 70.50, okay? That's where we got to think the stock is going to be at expiration to make this trade worthwhile. If you don't think it's going to be there, you wouldn't do the trade, right? Okay. So there we go. So that's that. Let's do this. Let's go and let me go back here. And let's talk about theta. Okay. Time decay. Theta, time decay, theta for $4 a day. Okay. I just covered it up. That's 0.04 right there. Okay. 0.04. That's working against us. If it's not working for us, it's working against us. And in this case, so if it goes sideways, that's a drag on the trade. Well, that's what we get for the higher potential reward type trade. Now, I'm not going to take the time to do it, but if you want to kind of model out what the potential rewards could be on this trade, go up here and go to Theo Price and do that. Okay. Go to Theo Price, and then you can change and see how much that stock may be for different scenarios if the stock goes up or whatever. But theoretically, this has an unlimited gain, so it could go up. Okay. So it could go up very high. But again, our probabilities aren't great on that. Implied volatility, 0.08 on that. That means every point of implied volatility that goes up, it would tend to benefit our trade. Well, our implied volatility right now, this is the monthly average. I don't know exactly what on that contract. I want to leave this up for 1 sec, is about 35%. Well, if implied volatility goes up a couple percent, that would tend to help the trade out. Well, 2% increase in implied volatility times my Vega, that'd be about $16 benefit. If implied volatility goes down 3% from here, then that would tend to, that would hurt the trade, hurt the long call. 3 times 28 is 24. That would hurt it to the tune of $24. So there we go. Okay. So that's the trade that we're looking at here on this. Now, Sam said, I wouldn't do anything before the Fed announcement today. You know, today, let me go out of PayPal for 1 sec. We'll get to PayPal for 1 sec. But let me, I think Sam brings up a good point. If we look at today, here's the trading we got today. Kind of lackluster, right? And we kind of went up, and then I don't even know what that drop was there, but but it's kind of going more or less sideways right now on this. For the day, we're up 0.1%. Okay. I would be very surprised if after 2:30 Eastern time, you don't see some increased volatility on the SPX. I don't know whether that's going to go up or down, but I'd be surprised if there's not increased increased volatility on that SPX. Okay, let's go back to PayPal, PYPL. Okay. So there's the trade. Now, what I'm going to do is I'm going to actually place the trade here. We're going to enter it. When you click on a single option on Thinkorswim, it puts it in at the natural price automatically. You may be able to get a little bit of price on that. We actually have a 5-cent spread here, so it's not really that big a difference. Often what I'll do is I'll kind of split the difference. There's no difference to split here on this right now. So I'm going to go with that natural price. For my stop order, I'm going to put it on a stop. Stops aren't guaranteed, but we are going to put in this to try and help protect ourselves a little bit in case it drops. I'm going to put that in about a $3 stop there, about 60% of that stop price there, 60% of the buy price as my stop on that. I'm going to confirm and send. I'm going to put that in my long call category. I guess my long single options category, and send that. Okay. Now, I want to get to, and we filled, I want to get to management of trades, and I'm going to do that in just 1 sec. We could go through other examples here, and I'm not going to actually place the trade, but let's look at this. Let's look at like MDLZ, Mondelez, okay? Here's a trade where maybe you're looking at this and you're going, well, we bounced off this once, twice, 3 times, 4 times. We don't have higher highs right now on this. We have equal highs. Okay, that's the difference between this trade and the PayPal one we were just looking at. PayPal, we had a clear uptrend, higher highs, higher lows. This one, well, we kind of have higher lows more or less. Maybe we're kind of creeping up a little higher, but we have maybe a significant resistance. Maybe you're more bearish on this. Okay, you could do a different trade. Then you can look at the implied volatility on it. Where's that going to go? I don't know. This is maybe a little bit more mid-range. Maybe not. Maybe it's a little bit low. But remember the framework when we're doing this. Wiley said, what about an iron condor? Yes, remember, when we're doing these trades and we're pulling this up and we're saying posture, what's your posture? Bullish, bearish, neutral. Well, neutral is a valid possibility there. What kind of trades may fit a neutral posture? Well, maybe an iron condor may fit a neutral posture. Maybe a butterfly. Butterflies usually are not as high a probability type trade. Butterfly. A calendar spread. Okay. In terms of buying and selling iron condors, you're a seller. Okay. These are for neutral. Okay. These are for neutral. Calendars would be typically you're buying. That's Vega positive. Okay. All right. And butterflies, we're typically looking to sell. Okay. All right. So that's in terms of implied volatility. This is iron condors. Iron condors tend to be, well, it depends what strikes you pick. You can make them higher probability or lower probability. Okay. Butterflies tend to be lower probability as opposed to calendar spreads. Okay. But let's take a look. So anyway, you got a whole universe of option trades that you can do. Consider these 3 items before you start trading options. All right. Now, let's do this. I want to go to the monitor tab and I want to look at some trades. Number one, I wanted to look at, I got Goldman Sachs here. I don't have a trade on here. Look, PL open, PL day, nothing. Let me get rid of this left-hand column, make it a little bigger. What does that mean? Well, I've got an order on it. What happened with this order? Let's see. We placed this order on 424 to enter a short call vertical. It's a bearish trade. It never filled. We had a condition on this to enter that trade. Well, let's look at Goldman Sachs. That's a bearish trade. Are we bearish? I'm not so bearish anymore on this. Before we were thinking, well, maybe if it breaks down, we're going to get in the trade. Well, it's just kind of gone up since then. At this point, I'm going to just say, I'm not interested in this trade anymore. So I'm going to get rid of this trade. You can just exit out right here, by the way. Okay, I can just X that out. And we just canceled that trade on there, okay? So no longer is Goldman there. Sometimes you do that. It doesn't matter the type of trade. It doesn't matter whether you're doing a short vertical or anything else. You are, if the trade no longer, what's the expression? If the shoe no longer fits, then get rid of the trade, right? Let's do this. Let's go to one. We did a couple last week, okay? I did a couple trades, earnings calendar trades, not in this class, but in our advanced options class last week. And AMD was one of them. The trade was an earnings calendar, a calendar spread explicitly to trade on earnings. Okay? On earnings. So we did a trade on that. And earnings came out. And the stock didn't really move much, okay? This is like, a lot of times on earnings, you expect a bigger move. It just hasn't moved that much. And so what happened is, it actually turned out pretty well, didn't it? We made some money on that, and that's largely due to implied volatility effects on that calendar. So if you are interested, go to the advanced options class last Friday. We talked about earnings calendars, which is kind of a special use case of calendar spreads to try and take advantage of what we call an implied volatility crush. But in this case, when we do an earnings calendar, such as AMD, then it's done. Once the earnings comes out, we're typically going to exit that trade. So what I'm going to do is I'm going to exit that trade. Made a little bit of money. I'm going to create in the paper money. I'm going to close that trade out, and we're going to confirm and send, and we're going to get rid of that trade. Okay, Disney, not the same. We weren't so fortunate on Disney. Disney, let's take a look at Disney. And so we did 3 contracts on Disney. Here's Disney, DIS. And what's Disney done? Disney shot up. Okay. So the plan wasn't for Disney to go up 11%. Well, look, we're wrong. I didn't know it was going to happen. Even Ben Watson, the guru of Disney, he knows more about Disney than anybody I know, probably wasn't anticipating exactly a 11% jump in Disney. Okay, maybe I'm wrong on that. But so that went up, and we're losing money on it, right? Here's the thing. Earnings calendars, once you're past earnings, you typically don't even fiddle with it. Normally, you're just going to get out of the trade. So that's what we're going to do. We're going to get out of this trade. We're going to right-click, and we're going to create a closing order. We're going to get out of this guy and confirm and send and be done with it. We guessed wrong. Okay. Jesus said PLTR. Palantir had earnings too. Did we do a trade on Palantir? We didn't. So we didn't do the trade. So there's no earnings trade to look at in terms of our trade management on this. I don't have a trade on Palantir, so I can't manage that trade. All right. So let's I mentioned I want to talk about long verticals here. Okay. So we've got some long verticals. We've got a few minutes to go. And I just want to go through these. And this one actually was, we were losing money on this earlier, but it actually flipped a little bit there. And so here's CRM, Salesforce. This is a long vertical, a long call vertical. We're bullish. Okay. We're bullish on this. 260 to 270. When I look at a long call vertical, here's what I do. I look at the strikes and I say, where is the stock in relationship to the strikes? Well, the stock is right in the middle of those. Okay. Obviously, on a long call, we want it to be up at 290 or higher. That would represent max gain at expiration. If we're at between the strikes, how well we're doing really probably largely depends on where we started. If the stock was lower and got to this point on a long call vertical, we're probably doing fairly well. Of course, you can always look at your PL open and see how things are going as well. But here's what I would say. There's a lot more that we can do with this, but if our forecast has changed, we may get out of it. So let's look at CRM. Here's CRM. Okay, here's CRM. Let me zoom in. Potential support levels here. I'm going to clean up this drawing set just to make it a little easier to view. Okay. We've broken above. We have higher highs, higher lows. We have a trend that's up. And I'm just going to stick with it. I don't see any reason not to be bullish on this from a technical standpoint on this. Now, I could be wrong, for our class at least. This may very well go down, but the technical aspects that we're looking at are still bullish. So I think we stick with CRM there. Okay, so let's do Duke Energy. Okay, here's Duke Energy. So this is the one that was we were losing earlier today on this. Again, our strikes, 120, 125. Where's the stock? The stock's like right in the middle of those. Am I still bullish on this? The UK? I see no reason to be bearish on this right now. Okay, so we're going to stick with this. And let's look at another one. Let's look at this one, because this one I think is illustrative of something else. 170, 180 call. We're kind of mid-range on this. We're doing fairly well. We've made some money. Maybe let's double check. We have a stop on this. We're looking at PM here on this. And let's see what our condition on this is. Condition is if the mark is less than or equal to 168. 168. I don't want to give up too much money here. Let's just see if, could we possibly move that up? Here's Philip Morris right now. Hold on. Somehow I got that symbol wrong. Try that again. Here's Philip Morris right now. Okay. Our stop is, and it's not technically a stop, it's a conditional order to get out, is if the stock goes down below 168, which is right around here. You know what? I may move that up. Even though there's not like a huge resistance level here, or support level, I should say. What I may say is, maybe we got something kind of right in here. Okay, about 172. That's where our highs were that we bounced off of, there and there. We broke through it. And if we break down below that, I probably want to try and get out and capture some of those gains in there. Let's see if we can capture some of the gain. So even if it does reverse itself, maybe we'll still be profitable, or if not, maybe we'll be able to get out without losing money, without getting all the way down to that stop. So what I'm going to do is, I'm going to right click on this. I'm going to, I want to, hold on one sec. I'm going to click on that. I'm going to right click on this, and I'm going to cancel and replace that order. And I'm going to go to my gear. And notice right now we say if the mark is less than or equal to 168, we're just going to creep that up a little bit. It's just all about money management, folks, trying to capture a little bigger wins, trying to reduce the losses. Losses are inevitable, but hopefully we may be able to reduce this loss there. Okay, so we're going to convert this in. That's going to overwrite the other. It's going to cancel the other one and put in a new order here on Philip Morris. Now, what happens sometimes is you do this, and now we had it allocated, and now you're like, where's my stop on this? Okay, where's my stop on this? Well, my stop is, it's there, it just doesn't have those grouped together. So let me see if this will let me, it's not going to let me. So what I'm going to do here is I'm going to take Philip Morris, I'm going to unallocate it for a sec. So I'm going to move to group, unallocated. Now these are all going to be linked up. And now if I move this back to my long verticals group, now it has that stop sitting there with us. Okay? And there we go. I think I'm going to call it there because I'm just about out of time and I just want to summarize here. And I think UPS is, well, actually, let's look at this. Oh, this is actually a different one. So, you know what? We're under 10 days to expiration. We've made a little bit, nothing to brag about, but let's just take that profit. We'll take little profits as they come, especially since we're getting close to expiration. As we get closer to expiration, gammas go up. In other words, another way of saying that is the possibility of big swings in price movement goes up as you get closer to expiration in general. And that swing may go for us, but it can also go against us. I don't want to, snatch defeat out of the jaws of victory, so to speak. So I'm just going to look and I'm going to close out that UPS trade here. We're going to create a closing order, take a gain, small gain, and send that and send that. Okay, thank you very much for joining me today, everybody. I wanted to go through, in addition to the money management, we kind of focused in terms of money management on long verticals today. Each week we kind of shift on different types of trades. Sometimes we do a lot of them. Today was more of a focus on on the long verticals. But I also wanted to mention those kind of 3 key items I want you to consider before you trade and before you decide what type of option trade to do. Thank you, Ben, always, for joining me and helping me out in the chat. And thank you, each of you, for taking some time out of your day. I know there's other things you could be doing with your day. Thanks for spending your time with us. And coming up next, we have trading price patterns. So everybody have a great rest of the day. Hopefully the Fed news is positive for everybody. Have a great day, everybody. Bye-bye.